Let us start with the discussion on financial ratios, which consist of 71 MCQs. This financial ratios, which is A2, consist of many several parts. The several parts, it's like ratio, so that is divided into 5 subtopics or 5 ratios. So the first ratio we have liquidity ratio, the second we have leverage ratio, third we have profitability ratio, fourth we have market ratios, and fifth we have activity ratios. These classifications are given by the IMA, Institute of Management Accounting. It's not my classification, it's given in your syllabus that these are the ratios that needs to be understood, that needs to be focused on. So how it is, this is your content CSO, which is called content specification outline, and these are the financial ratios that IMA wants you to know. The first one is liquidity, leverage, activity, profitability, and market ratios. So this is what it's depicted here, and as well as the formula. So first we'll start with the liquidity ratios, and we'll do all the MCQs that are related to the liquidity ratios in the exam support package. So in this liquidity ratios, we have two ratios that we need to focus on. We need to focus on the current ratio, and the second ratio that we need to focus on is the quick ratio or acid test ratio. These ratios, like cash ratio or cash flow ratio or net working capital ratio, is not important. So the two ratio that is important is current ratio and quick ratio or acid test ratio. So one need to focus on these two ratios only, and the testing will be on these two ratios only. It's very rare chances that you will be tested on cash ratio or cash flow ratio or net working capital ratio. So let us start with the exam support package related to the liquidity ratios. In analyzing the short-term liquidity of a firm, many analysts prefer the use of quick or acid test ratio rather than the current ratio. The primary reason for this preference is that why the analysts are using the quick ratio other than the current ratio. So let us see the difference between the quick acid test ratio or the current ratio. So current ratio is cash plus marketable securities plus accounts receivable plus inventory plus prepaid expenses by current liabilities. Quick ratio includes cash plus marketable securities plus accounts receivable by current liabilities. Quick ratio is more conservative and the current ratio is less conservative. So let us see the primary reason why it happens like this. So why the analysts are using quick ratio rather than the current ratio. So quick ratio excludes accounts receivable. No, quick ratio account receivable is included in quick ratio, and account receivable is included in current ratio. So it is included in both the ratios. Current ratio includes marketable securities which may be mispriced. So marketable securities is included in current ratio, and marketable securities is also included in quick ratio. If it is mispriced in current ratio, it will be mispriced in quick ratio as well. Pro forma cash flow statement focuses on cash. We are not discussing here the cash flow statement, so this is the incorrect response. Conversion of inventory into cash is less reliable. Yes, inventory is not included in quick ratio, but inventory is included in current ratio, and it's very hard to convert. Sometimes it's very hard to convert your inventory into cash. So that's why the analysts use current ratio, because inventory gets damaged, inventory gets obsolescence, the price of inventory can decline over the time period. So that's why quick ratio is much more reliable measure of short-term liquidity of a firm rather than the current ratio. So conversion of inventory into cash is less reliable. So this is the correct option for this MCQ. So let us proceed to the next MCQ. The balance sheet of a luggage manufacturer reports the following. We have cash, we have accounts receivable, we have inventory, we have marketable securities, we have current liabilities, and we have long-term liabilities. Based on the information provided, the luggage manufacturer's quick ratio. So they are asking for the quick ratio. So they are asking for quick ratio. So quick ratio is equal to cash plus marketable securities plus AR by current liabilities. So the cash, we have cash is 531,000, we have plus cash, we have account receivable 439,000. Inventory is not included in the quick ratio. We have marketable securities by current liabilities. So current liabilities is 500,000 and cash we have 531,000, 439,000 and 200,000, which gives you 70,000, and which is 2.34, and the correct option is 2.34. Next, Brumal Corporation has decided to include certain financial ratios in its year-end annual report to shareholders. Selected information relating to its most recent fiscal year is provided. So we have cash, we have accounts receivable, prepaid expenses, inventory, accounts payable, notes payable, bonds payable, net credit, sales for year, and cost of goods sold. They are asking for working capital. So the working capital is the difference between current assets and current liabilities. So working capital is equal to current assets minus current liabilities. So let us find the current asset from here. Cash is a current asset, account receivable is a current asset, prepaid expenses is a current asset, inventory is a current asset. So 10,000, 20,000, 8,000, 40,000 is the current assets. Current liabilities 15,000. 15,000 is current liabilities. Notes payable in 90 days is current liabilities. Bonds payable no. Net credit sales for the year no. Cost of goods sold no. So we are left with 15,000 plus 25,000. So which is equal to current assets are, the total current assets are 80,000 and the current liabilities are 40,000, which is 15,000 plus 25,000, which is 40,000, and this equals to 40,000. So which is, so 40,000 is the correct option. Next, following are affected where merchandise is purchased on credit except. So when you purchase merchandise on credit, what happens? You debit your inventory. Inventory is debited and your accounts payable is credited. So in this entry, your current assets increases as well as your current liabilities increases. So let us see the option. Total current assets. So if current asset is increasing, your total current assets will increase, because your current asset is increasing, your inventory is increasing, and inventory is increasing, inventory is your current asset. Total current liabilities. So total current liabilities is also increasing because your accounts payable is increasing. So your total current liabilities will increase. Current ratio. Current ratio is current assets by current liabilities. If your current assets increasing, your current liabilities increasing, this will affect your current ratio as well. So working capital. Working capital is the difference between current assets minus current liabilities. There's a difference between. So if your current asset is increasing and your current liability is increasing, this will have no effect on your net working capital, because your current asset is increasing as well as your current liability is increasing. This is just like plus and minus, so this will have no effect on your net working capital. Next, product has a flowing current assets. We have cash, we have marketable securities, we have accounts receivable, we have inventories, we have total current assets. If Bosch current liabilities are 1.3 million, the firms, what will happen? So let us understand the transaction first. Here there are transactions that if your current ratio or quick ratio is greater than 1, equal increase in the numerator and equal decrease in the denominator will have positive effect. It's the opposite direction. For example, if you are increasing certain amount in the numerator and certain amount in the denominator, what will happen? The ratio will decrease. If your current ratio or quick ratio is greater than 1, if you are adding the same amount in the numerator and the same amount in the denominator, the ratio will decrease. And if you are deducting the same amount from the numerator and the same amount from the denominator, what will happen? The ratio will increase. This is the first criteria, and the second criteria is that if your current ratio or quick ratio is less than 1, it is in the same direction. If greater than 1, it will have positive effect. If it is less than 1, it will have the same effect. So this means that if you add the same amount in the numerator and same amount in the denominator, the asset will increase. The ratio will increase. If you deduct the same amount from the numerator and the same amount from the denominator, the ratio will decrease. So if it is your current ratio or quick ratio is less than 1, the ratio, if you are adding the same amount in the numerator and the same amount in the denominator, the ratio will increase. If you are deducting the same amount from the numerator and the same amount from the denominator, the ratio will decrease. So let us see here. So here your current ratio is total current assets is 2.6 million, so it is 2.6 million by 1.3 million, which comes to P2. So your current ratio is greater than 1. Now let us see the quick ratio. So quick ratio excludes your inventory. So the quick ratio is 1150. So the amount of quick ratio is this one, because inventory is excluded from the quick ratio, so these are included in quick ratio, and the current liabilities are 1.3 million, so which gives you amount of 0.88. So your quick ratio is less than 1. So your quick ratio is less than 1 and your current ratio is greater than 1. So let us see what happens. Current ratio will decrease if the payment of 100,000 cash is used to pay 100,000 of accounts receivable. So decrease if the payment of cash. If you are paying, so current ratio will decrease if the payment of 100,000 cash is used to pay 100,000 of accounts payable. So equal in what will happen? Equal, the ratio is greater than 1. First, the ratio is greater than 1. So the effect will be, if you are decreasing something from the numerator and the same amount from the denominator, the ratio will increase. It will not decrease. Basically, the ratio will increase. Now, the current ratio will not change if the payment of 100,000 cash is used to pay 100,000 of accounts payable. The ratio will decrease because if the same amount is deducted from the numerator and the same amount is deducted from the denominator, the ratio is going to increase because we have current ratio is greater than 1, which is 2. Next, quick ratio will decrease if the payment of 100,000 cash is used. We'll discuss D1 first. Quick ratio will not change if the payment of 100,000 cash is used to purchase inventory. Quick ratio will not change. Quick ratio will change if the payment of 100,000 cash is used to purchase inventory. So in quick ratio, control minus quick ratio is cash plus marketable securities plus AR by current liability. So inventory is nowhere in quick ratio. So if you are paying 100,000 cash, means your cash is decreasing, so it will decrease your quick ratio because cash is decreasing and inventory is not there, so it will decrease your quick ratio. But quick ratio will decrease if the payment of 100,000 cash is used to purchase inventory. Yes, your quick ratio will decrease if you are going to make a payment of 100,000 cash to purchase inventory, because inventory is not included in the quick ratio. Next, shown below are the beginning and the ending balance of certain grimaces in accounts. You have cash, marketable securities, accounts receivable, inventories, plants and equipment, accounts payable, accrued liability, 7% bonds payable. So they are asking for acid test ratio. So acid test ratio. So we have acid test ratio. So quick ratio is cash plus marketable securities plus accounts receivable by current liabilities. So cash we have, this is we have cash, we have marketable securities, we have accounts receivable, and in current liabilities we have accounts payable and accrued liabilities. So let us add these and get the quick ratio. So we have in the numerator we have 144,000 and in the denominator we have 95,000. 95,000 is 84,000 plus 11,000, and in the numerator we have cash, marketable securities, we have accounts receivable. Inventory is excluded from quick ratio, so that is cash plus marketable securities plus account receivable, which gives you 1.5157, which is equal to 1.52, and which is 1.52. Next, Davis Retail Inc. has current assets current asset is 7.5 million and current ratio is 2.3, and current asset is 7.5 before purchasing 750,000 of merchandise on credit for resale. After this purchase, the current ratio will, current ratio here, the current ratio is greater than 1. If the current ratio is greater than 1, if equal amount is increased in the numerator and equal amount is increased in the denominator, the ratio will decrease, and the ratio is greater than 1, that is 2.3. So what happens, Davis Retail has current assets of 7.5 million and current ratio is 2.3 before purchasing 7.5 merchandise on credit on resale. If you are purchasing inventory for resale on account, what will happen? So you will pass an accounting entry, that is inventory debit and accounts payable credit. So what happens, your inventory is increasing and your accounts payable increasing. So this means your numerator is increasing and accounts payable, which is current liability, your denominator is increasing. If both is increasing, this means your ratio will fall from 2.3 to something. So what will happen, your ratio will not remain 2.3, your ratio will not be higher than 2.3, it will not be exactly, but it will be lower than 2.3. Next, Gasca Auto Parts must increase its acid test ratio above 0.9 level in order to comply with the terms of loan agreement. Which one of the following actions is most likely produce the desired result? So they must increase the acid test ratio above the current 0.9 level. So they want to increase the acid test ratio. So what will increase the acid test ratio? Let us see. So So first one is expediting collection of accounts receivable. So if you are doing this, what will happen? Your quick ratio is equal to cash plus marketable securities plus accounts receivable by current liabilities. So if you are converting account receivable, what will happen? Your account receivable is converted into cash. If your account receivable is converted into cash, there will be no effect on your current ratio, and your current ratio will be 0.9. But here we need to increase our current ratio from 0.9. We need to increase the current ratio from 0.9. So current ratio will be remain same from option A. Now, now making payment making payment to trade trade accounts payable. When you make payment to trade accounts payable, what will happen? Your quick ratio is less than 1. So if your quick ratio is less than 1, the same amount, if it is deducted from the numerator and the same amount is deducted from the denominator, the ratio will decrease. So making payment of trade accounts payable will decrease the ratio, it will not increase. So what we need? We need the ratio to increase, not decrease. Now, purchase of marketable securities for cash. If you are purchasing marketable securities for cash, what is going to happen? So cash is going out and you are purchasing marketable securities here. So there will be no effect by option C. So here option C will give you no effect. This will also give you no effect. No, this will, sorry. Making payment on trade accounts payable will decrease the ratio. This is this one. And purchasing of marketable securities for cash will have no effect. And collection of accounts receivable will have no effect. So we are left with option B. Selling auto parts on account. If you are selling auto parts on account, what happens? If you are selling auto parts on account, your inventory decreases and your accounts receivable increases. So inventory is nowhere in your quick ratio. Inventory is not included in quick ratio, but account receivable is increasing. So if your account receivable increases, this means that your current ratio will increase. So the correct option is selling auto parts on account. Next, the owner of a chain of a grocery stores has bought a large supply of mango. So large supply of mango is your inventory, and paid for the fruit for cash. So this means your inventory is increasing, your cash is decreasing, because you are buying inventory with cash. You are buying mangoes with cash. Cash is going out and mangoes are coming in. The purchase will adversely affect which one of the following? So inventory is your current asset and cash is your current asset. So your current asset is increasing, your current asset is increasing. For example, inventory, here inventory is increasing and cash is decreasing. So what will be the effect of these two? Current ratio will have the same effect, because your inventory is increasing, your cash is decreasing. So current ratio will have no effect. Current ratio will have no effect. Will have no effect on current ratio. Acid test ratio and quick ratio. Price earning ratio. This MCQ does not relate to price earning ratio, so this is incorrect option. So we have working capital. So there will be no effect in working capital, because working capital is the difference between current assets minus current liabilities. So there will be no effect on working capital. But And acid test ratio, there will be an impact on quick or acid test ratio because inventory is not included in quick or acid test ratio. That's why there will be an impact on quick ratio. So quick ratio, what does is included in quick ratio? We have cash, we have marketable securities, and plus we have accounts receivable divided by current liability. So your cash is going out, so there will be an effect on quick or acid test ratio. Next, when reviewing a credit application, the credit manager would most be concerned with the applicant. So the credit manager is concerned with the liquidity. Liquidity is the ability of the firm to make payments when due. So it's the credit manager is interested in the prompt payment. So he will be interested in the liquidity ratio. So let us find which are the combination which are correct related to the liquidity ratio. Profit margin, the credit manager will not be interested in profit margin because he needs the payment, he needs prompt payment, he needs early payment, he needs prompt payment. So he will not be interested on profit margin, he will not be interested on return on assets, he will not be interested in price earning ratio, but he will be interested in current ratio, which is the measure of liquidity. He will be interested in working capital, but he will not be interested in return on capital. He will be interested in working capital and he will be interested in current ratio because working capital and current ratio both are the measure of liquidity, and the supplier is interested in the prompt payment. Next, both the current ratio and quick ratio for a Spartan corporation has been slowly decreasing for the past 2 years. The current ratio has been There has been decrease in the current ratio. So the current ratio has been 2.3 to 1 and 2 to 1. During the same time period, the quick ratio has decreased from 1.2 to 1 to 1. It has decreased from 1.2 to 1, then 1 to 1. The disparity between the current and quick ratio can be explained by which one of the following? So they are asking the disparity between. So they are asking the disparity between the current ratio and quick ratio, which can be explained by which one of the following. So let us understand what's the difference between current ratio and quick ratio. So current ratio, we have cash, we have marketable securities, we have accounts receivable, we have inventory, we have prepaid expenses by current liabilities, and quick ratio. So quick ratio, we include cash plus marketable securities plus AR by current liability. So two things are not there in quick ratio. Inventory is not there in quick ratio. Inventory is not there in quick ratio, and prepaid expenses is not there in quick ratio. The difference between current ratio and quick ratio is the item inventory and prepaid expenses. So the current portion of long term has been steadily increased. This is included in your current ratio and quick ratio. So this one is common in both. The cash balance is usually low. It is low, it is high. This is common in both. Account receivable accounts The account receivable balance has decreased. The account receivable balance has decreased. This is common in current ratio and quick ratio. Inventory balance is unusually high. So inventory balance is not there in quick ratio, but it is there in current ratio. That's why this is the difference between current ratio and quick ratio. This is what the question is being asked for. The disparity between current ratio and quick ratio can be explained by which one of the following? It is the inventory balance is usually high. Next, the asset test ratio shows the ability of a company to pay its current liabilities without having to what? With it, what's the asset test ratio? So Let us write the formula of acid test ratio, which is, so quick ratio is cash plus marketable securities plus account receivable by current liabilities. So reduces its cash balances. It is there. So the asset test ratio shows the ability of a company to pay its current liabilities without having. So what's not included in quick ratio? So cash is included in quick ratio. It will have an effect on quick ratio without having to. So what item will not have any effect on quick ratio? Cash is included, so it will have an effect on quick ratio. Growing additional funds. If you're growing additional fund means your cash is increasing. It will have an effect on quick ratio. Collect is receivable. If you are collecting your receivable, it will have an effect on your quick ratio. But inventory is nowhere in the formula of quick ratio, so it will have no effect on quick ratio. Either you liquidate or do whatever, so it will not have an effect on your inventory. Next, all of the following are included in calculating acid test ratio except. So what is acid test? What is the formula to calculate the acid test ratio? So acid test ratio, quick ratio, is equal to cash plus marketable securities plus account receivable by current liabilities. So these are included in quick ratio. 6-month treasury bill is marketable securities, which is included in current ratio. Prepaid insurance is not included in current ratio. Accounts receivable is included in quick ratio. 60 days certificate of deposit is marketable securities, which is included in your quick ratio. But prepaid insurance is not included in your quick ratio. So all of the following are included when calculating acid test ratio except the prepaid insurance. Next. So the Ram Corporation has decided to include certain financial ratios in its year-end annual report to shareholders. Selected information relating to its most recent fiscal year is provided below. We have cash, we have accounts receivable, we have prepaid expenses, inventory, accounts payable, notes payable, and bonds payable. So the Ram quick acid test ratio at the year end is what? So they are asking for acid test ratio. So let us find the acid test ratio. The acid test ratio is quick ratio. So quick ratio is equal to cash plus marketable securities plus accounts receivable by current liabilities. So let us find cash. Cash, we have 10,000. Accounts receivable, we have 32,000. Prepaid expense is not included in your quick ratio. Inventory is not included in your quick ratio. So and these are your numerator, which is 42,000, and we have current liabilities, which is 15,000 plus 25,000, which gives you 40,000. So the quick ratio is 1.05, which is 1.05. Next, a company has a current ratio of 2:1 and pays off portion of accounts payable with cash. The current ratio will what? So here what happens is your current ratio is greater than 1. Your current ratio is greater. If your current ratio is greater than 1, any same item that is added in the numerator and the same item that is added in the denominator will decrease the ratio. And if the same item is deducted from the numerator and the same item is deducted from the denominator, the ratio will increase. So here what is happening? if the company has current ratio of 2:1 and pays off a portion of accounts payable, with cash. So here your accounts payable is decreasing and your cash is decreasing. So your accounts payable is decreasing, that is your current liability is decreasing, and cash, which is your current asset, is decreasing, and current ratio is current assets by current liabilities. So your current liabilities is decreasing and your current asset is decreasing, which is this one, and your ratio is greater than 1, which is 2.1. So your ratio will increase, and the option that is correct is the option B.